A border tax adjustment. In the first part, we concluded that a whole change of tax regime from one based on income tax to one based on VAT would have deep consequences, heralded by a currency appreciation. Some studies put the VAT equivalent rate for the current US regime at around 20 to 25%, with important sectoral differences. If that is the level of currency appreciation, it should have huge implications for non-tradable sectors within the US, for US capital markets, and for trade in capital markets in the rest of the world. The real implications go well beyond the limited theoretic model of one product imported and one exported in a small country without currency. In these circumstances, the idea that an exchange rate appreciation will handle the taxation charges is far from guaranteed. Worse, the theoretic requirement is a real exchange rate appreciation. It could be reached through inflation. An initial theoretic weakness appears because the importer and the exporter are normally different enterprises, so the cancellation of gains and losses cannot be done within a single enterprise's accounts. Some mechanism must be instituted for this purpose, and as we have already seen, it has limitations under WTO regulations. It cannot be instituted as a direct rebate to the income tax. Another problem in this simple theoretic model is the sequencing. The first impact is on import and export prices. Then the exchange rate should change to bear the burden of the change. But this change might be slow and the intermediate state could derive into a permanent one before things would come back to normal. In particular, it should be noted that if the exchange rate adjustment is slow and part of the adjustment is borne by prices, the answer from the FED could fundamentally and permanently derail the expected result. Last but not least, an appreciation or an expectation of appreciation of the world's main reserve currency would propagate huge adjustments in current and capital balances around the world. This is, however, outside the purpose of this short text. In view of the deep impacts of a whole change of regime, it is understandable that the projected bill in Congress is not aiming at a whole change, but to take small steps in that direction, such as the proposed border adjustment tax. As any mixed regime, it could be complex to institute and manage, because it aims to compensate the differences between the VAT regime and the current US income and sales tax regime. Trying to do this on a country-by-country basis means discriminating between WTO parties, again prohibited by WTO. A flat border tax might be WTO-compliant and is the kind of tax found in the Congressional proposal, a flat tax of 20%. On the other hand, the rebate to exporters might be instituted as an exact refund of indirect taxes, border tax comprised. As explained in the first part, any rebate on direct taxes for exporters is the definition of a subsidy in WTO, and therefore prohibited. Following this path, the US will end up with a system very similar to VAT, a flat tax at the border, equivalent to the direct taxes paid by domestic products in the domestic market. Although it would be very similar to a VAT system, the proposed mechanism might be susceptible to WTO disputes. Two main problems: how to guarantee the same tax being applied to each product competing with imports, and how to give rebates to exporters without falling into the subsidies definition. This has two additional practical disadvantages. It wouldn't have the informational benefits of VAT, and the agreement between the federal government and the states seem full of difficulties. In fact, this has already been tried and scrapped in previous legislation in US Congress because of the aforementioned problems. Conclusions. The progressive extension of a VAT system around the world in the last half-century has left the US as one of the few countries outside of it. This fact poses apparent disadvantages for exporters and incentives to imports. Any adjustment would have an exchange rate component, meaning a dollar appreciation that theoretically will counterbalance those incentives and disadvantages. However, it is at the very least naive to think that the exchange rate will take on the whole and exact burden of the adjustment. In a more realistic approach, enough consideration should be given to the central role of the US dollar in capital markets, to the international trade regulations, and to the shocking possibility of having inflation as a part of the adjustment process. Considering the international trade regulation, the realistic way to implement a border tax in the US is making use of the VAT system. This will give big incentives to exports and big disadvantages to imports. If it is the selected solution, some dollar appreciation may be expected, and some inflationary pressures within the US shall occur. In the case of a slightly different mechanism, WTO's dispute settlement mechanism will have a lot of work in the next few years.